Assalamu alaikum. Okay, friends, towards this last video, now we see the analysis of the account receivable, just like the analysis of inventories. So there are two ratios. Just like the inventory turnover ratio, we have a receivables turnover ratio. So how many times we collect our receivables during the period? How many times we roll over our receivables during the periods? So let's say we have sales of 1 million and all the sales are credit sales, right? So sales of net credit sales of 1 million. Net credit sales means sales minus sales returns, etc., etc. And we have at any given point in time we have receivables of 100,000, right? On average we have receivables of 100,000. It means how many times we have converted these receivables into sales, or in other words, how many times we have collected the money from account receivable. So the total credit sales is 1 million, whereas the account receivable is 100,000. It means we have turned over the receivables 10 times. So every time we make a sale for 100,000, then we collect it and then make another sale of 100,000. This way we make 10 different sales for 100,000 on average, right? So this is what the idea behind the receivables turnover. The formula is net credit sales divided by the account receivable, average account receivable. So for average account receivable, again, we have to work out uh, either the average of 12 months if there are data points, or otherwise we just take the last year account receivable plus this year account receivable, because the last year account receivable in the balance sheet of the last year is the opening for this year, right? So that's the opening plus closing account receivable divided by 2. So this is the average account receivable, and we get the receivables turnover. So this is the first ratio, right? So higher the turnover, better the performance of the company in terms of its credit policy, its credit collection, right? So 12.8 times over here, you can see that the company converts its receivable into cash and then originates another receivable, and that collected into cash and then originate another receivable and collected into cash on average, right? By 12.8 times during the year. So every receivable is collected 12.8 times during the year. Now let's say it's 12, right? Assume it's 12, not 12.8. Now if receivables are collected 12 times a year, it means for how many days the receivable on average is collected. So there are 12 months. So it means every month we are collecting our receivables. So this is known as the receivable days. So what is the formula of receivable days? It is the days in a year, which is say 360 or 365, divided by the account receivable turnover. So whatever the receivable turnover we worked out here, right? Or we can just reverse the order of these two. So the turnover is actually this one. So it's a division sign. So 365 divided by 12.8 means every 28.5 days over here in this particular example we collect our receivables. Now this is something which we can compare with our credit terms. So let's say our credit terms are 2 by 10 and by 30, and which means that the maximum credit period we allowed our customer is 30 days and by 30, and our average collection period is 20.5 days. Now this would mean that majority of our customers are not availing discount, they are paying just on the 30th day or the 29th day, right? So only a very small fraction of the customers is actually availing discount. They are paying in 10 days, because if all the customers are paying 10 days, then this period average collection period should something around 10 days or 11 or 12, means more customers are actually availing discount, right? So this credit average collection period should be compared with the credit terms as well. So especially the n by x, n by 30, and n by 40. So if my credit terms are n by 20, 1 by 10, n by 20, it means my maximum credit period is 20, but I am collecting my receivables 28.5 days. It means my credit policy and credit collection is not effective. Even my customers are not paying in time, they are all paying late, right? Which means that either my selection of the customer is not correct, or my credit collection, means the collection formalities, the pursuing the customer, following up with the customer is not good. So these are the implications of these ratios. Again, these ratios have to be compared from the industry statistics. So for some industry, for example retailers, right, the receivables are not there altogether. For some industries the receivables are there, but the turnover is very frequent, right? So the number of days could be just 3 days or 4 days. So it depends industry to industry. So we can compare these numbers, not across industries but within industries. There are some other examples over here, and that is the end of the chapter. So thank you, and I hope that these videos would have worked, and we can discuss the concepts in next class, provided that you have watched all the videos and practiced some questions.